Good afternoon, everyone. This is Robert Rayburn here at Life Pro Asset Management. It is July 22nd of 2024. Again, really glad that everyone could join us this week. We've had a lot happening in the market. One of the big messages that we've been going out with to our clients, to our advisors, to prospects, and the wider audience out there is that we believe that sooner or later there was going to be this rotation, right? The crowd and everyone else piling into mega cap tech. We saw the distortion in index performance because increasingly a higher and higher percentage of the S&P 500 was dominated by a handful of stocks versus the other 495 companies in the index. And at some point, you just run out of gas. You run out of investor flows to support these stocks and support pushing them higher. And at some point, there's a dynamic that changes that makes the other 495 stocks look pretty darn good. And we've had a confluence of events over the last 2 weeks. We're going to go over all of that in today's presentation that have come together to really make that other 495 those 495 stocks look really attractive relative to the overvaluation that we've seen take place in those 5 or 6 mega cap growth names. In addition to that, small caps, international stocks, emerging markets, a lot of these groups that have been orphaned for many, many years are starting to come back into the light as these events take place. So let's go ahead and get started so we can go through the details of what all of this means. Now, the market had a pretty nasty week last week, and we got a lot of questions of, whether the market has peaked, whether we were in a bubble and we're unwinding this bubble. And our message is consistent, is that there are parts of the market that look like a bubble to us, and there are other parts of the market that look really cheap to us. We're trying to invest in the parts of the market that look really cheap, that we think have upcoming catalysts, that we think are timely, right? Timing is incredibly important on the investment side. Probably the hardest part of the investment landscape. So we did see a strong run for stocks. You would have to be living in the Sahara Desert to not have realized that, right? Obviously the S&P 500, the Nasdaq posting records month in, month out. That came to an end last week. Strong pullback, especially in the Nasdaq, as we saw that rotation begin to take place. So 3 big things that we're going to talk about this week. What drove stocks lower, and do we see more pain? Number 2, what is the potential impact of the events surrounding the presidential candidate Donald Trump, his potential for taking power, and what does that mean for asset classes? What outperforms, what may outperform or may underperform in that type of scenario? And is the rotation of mega cap tech and into small caps a big deal? And does it have durability to that move? All of these are going to be the important points that we talk about. So if we think about it, there was this big setup, right? We had falling inflation, as we saw with the CPI report that came a week and a half ago, and the potential for this Trump presidency, a return to Trump to the White House, that led to this giant rotation that we've seen take place in the market. The big setup, though, was what happened before. And if you go through those weekly updates that we've been sending out, one of the big lessons, or not lessons so much as observations that we've been discussing and talking about, has been how crowded the mega cap tech stocks were going into the summer, going into the spring, right? And the problem with timing a bubble is that bubbles can last a lot longer than you have patience for, right? And it can make you look silly for not being in that bubble when the party is going. But when it starts to unwind, it can unwind quite rapidly. And the other thing is, don't confuse a bad price with a bad company. You can have great companies, but bad prices, and you can have bad companies with great prices, right? And so what we saw was that a lot of these very high quality mega cap tech names were absolutely killing it on the business front. Things are going very well for them. Revenue growth is strong, margin expansion, good free cash flow generation, but the valuations are out of whack. The example I use on a lot of client calls is, a lot of people like the Model 3 and Model Y Tesla cars, and they have a lot of value at a 20, 30, $40,000 price point. But if I say, hey, I'm going to charge you $300,000 for that Model Y, most people would scoff at that. They would say, well, no, that's way overpriced for this car. I love the car, but not at $300,000. And I think we started to see that dynamic take place. So what caused its perpetuation was that there was no other options, right? As people looked at the overall market and said, hey, there's a lot of areas of the market that were slowing down. There's not a huge amount of catalyst for these value names. We don't know what's going to happen in the presidential race, but we do know that mega cap tech is killing it. We know that they're generating a ton of earnings growth. So I'm just going to hide there. In other words, we saw more and more people hiding with this idea or this excuse that AI is the big catalyst there. And it is to some degree. But then we had that low inflation report that came out a week and a half ago, which led to lower rates, which tend to be good for non-mega cap growth stocks. So if you'll notice, something like ARK funds is down significantly this year, even though mega cap tech has had a run. Because even within technology, mega cap tech and semiconductors have had huge outperformance this year. The rest of that the rest of that tech group has lagged. And you see it with names like ARK funds that are down double digits year to date. But then we got the second catalyst, right? So those names, by the way, tend to do better when rates start to fall down because their terminal rate or most of their value that's ascribed to the stock tends to be back-end loaded way in the future. So when rates come down, their discounted cash flow or that DCF valuation tends to go up because most of the value is way out in the future. The second thing that hit was the Trump presidency, right? This idea of a potential Trump presidency. Very poor performance from President Biden during the debate, followed up by the assassination attempt of Trump and the way that Trump responded to that and the way that you had a lot of momentum behind his campaign really sort of fuel this idea that, hey, this may not actually be a 50-50 split in the election. This actually may be a landslide Trump victory. When the market started to sniff that out, we had the confluence of two events: a potential president who favors deregulation and lower taxes, a pro-growth president, combined with lower inflation and lower interest rates. So we need to find the stocks that do well, but we also need to find the cash to pay for those stocks, right? And so the second piece of this dynamic, of course, is this week and the non-farm payrolls. Jobless claims keep creeping up. Non-farm payrolls started to slow down earlier in the month, right? So we see these jobless claims have been trending upward. Why is that important? Lower inflation plus what we call brown shoots in the economy. In other words, signs that the economy that was overheated is starting to slow down, backing this concept that the Fed can cut interest rates in the fall. So I want to sell those stocks that I was hiding in, and I want to buy the stocks that'll benefit from lower rates and a pro-growth, low tax, low regulation president. How do I find the money to buy it if all my money is sitting in mega cap tech? Well, it's easy. In order to buy the rest of the market that tends to benefit from this dynamic unfolding, I need to sell the stocks that I've been hiding in, which are mega cap tech. So in order for me to buy it, I got to sell big tech, and then I take that cash that I've raised to buy the rest of the market. And that's the opening signs or the opening potential for a rotation in the market. So what was that recipe for the rotation? Inflation comes down, interest rates come down in response to that. This is the 10-year interest rate. As you can see here, big head and shoulders top, breaking down below support, and as we approach that 4% line. right? This has implications for not just equity investors, but bond investors as well. So if you are on the fence about whether to lock in some streams of protected income through an annuity, or you're interested in a bond strategy that has high rates, like right now, our bond strategy is in that 8 to 9% range. Now's the time you want to really execute on it, because as rates start to come down, those products are going to get repriced lower in terms of the interest rate or the payout that they're offering. Even more convincing dynamic from the 2-year yield chart, right? The 2-year yield is the most effective vote that investors make on the potential for Fed funds policy in the future. So what happened last time the Fed paused, then cut rates? What happened? When was that? Well, the last time we saw that was in the early 90s. So in the early 90s, we had the first George Bush presidency. They got voted out of office on a slowing economy. Bill Clinton comes into office, and what you start to see is growth pick up, but we get an inflation scare. That inflation scare was then followed by several rate hikes to arrest the inflation surge that we saw in the economy. Eventually, the Fed got its way and inflation started to come back down, but growth stayed steady, right? Or slowed down a little bit. So that was followed by the Federal Reserve pausing rate hikes. And then once they got comfortable, they started to cut rates to make sure that the economy continued to grow. As a result, what we saw here was one of the strongest periods of positive trend for the S&P 500 of all time. The S&P rallied almost unabated for 4 straight years. You had a couple corrections here, as you can see here in 96 and 97, but almost unabated for 4 years. We saw the S&P 500 rally in positive trend. So what's happened so far with that recipe that we've seen? We've seen a massive rotation in the small caps. This is the Russell 2000. The rally that we saw in the Russell 2000, that 10 to 12% surge in the Russell 2000, is the biggest outperformance relative to the S&P 500 in over 100 years. The percentage of stocks at 20-day highs hit 75%. The advanced decline ratio, 18 to 1, 17 to 1. And the reason why I'm bringing this up is that when you get these explosions, and I believe we kind of talked a little bit about this a week ago or 2 weeks ago, these explosions don't happen and then resort back to normal. They tend to occur because something has changed. A dynamic has changed. And there's durability to the move. Now, can you get the back check a little bit? We saw that last week. Absolutely. You can get a back check off that explosion, a check back into the breakout point before that resumption higher. But you do tend to have a continuation of that explosive event. So I don't think that's what some people have suggested, a blow off top or anything, nothing like that. Because if we look at the Russell 2000 here, been consolidating for over a year. And then you get this explosion to the top. That is what we call a breakout, not a blow off top. And rotations do matter, right? So even though the indexes are down week over week, and we saw a big correction in those headline indices, there's a lot of stocks that were up. And to show this dynamic, the best performing stocks since October of 2023 were down 3% for the week, while the worst performing stocks were up 0.6%. Now, it happens to be that the best performing stocks are those large mega caps that really impact how the S&P 500 moves. So these indexes are down, but if you were in a lot of these average stocks outside of the top 5, you might have made a decent amount of money. And then we look at the Russell 2000 relative to the S&P 500. It had been in its worst performing state since, guess when? The mid-90s. What happened in the mid-90s? Let's scroll right back up to that example that we use. This example, it was the inflation surge, Fed hikes rates, pauses to see if they're winning the battle. They start to win the battle and they cut rates. A 4-year rally in the S&P 500. Excuse me. And then we see further evidence of that rotation when we look at the NASDAQ versus the S&P 500. So NASDAQ has started to correct. We've had a very decent correction so far with the NASDAQ. We see that in the internals, the daily change plus minus 2 standard deviations, significant here, multiple days where we've seen that 2 standard deviation move to the downside by the NASDAQ versus the S&P 500 has not really been impacted as much, right? Now it's impacted because you have those mega caps going down, but also offset to some degree by the rest of the 495 stocks that are offsetting that move to varying degrees. You can see that the advanced decline ratio very just -1 to 1. So again, no huge selling pressure underneath the surface for the S&P 500. And then, of course, you add Trump to the mix, right? This potential that Trump can come back into the White House. So we go back to that 2016 election. What were the best performing sectors? Banks, trading companies, consumer finance, airlines, capital markets, media, insurance, machinery, automobiles. It just happens to be that a lot of these stocks tend to be in the small cap or the value areas of the market. It's as simple as that. So when we think of what benefits from low rates and lower inflation and cuts by interest rates by the Federal Reserve, well, emerging markets, small caps, value. What tends to benefit from a pro-growth candidate that wants low regulation? Well, guess what? The same kind of value stocks, cyclical stocks, emerging markets, small caps, because small caps tend to be more US focused versus global because they're smaller. So there's a dynamic play now. So there's a reason the market's trying to tell you something with this explosion of the Russell 2000 relative to the S&P 500 to the upside. There's a dynamic that's starting to change. The market is sniffing out that something is changing. So what works? Lower rates, lower inflation, a non-recessionary environment benefit companies and countries that rely on those lower funding rates, right? So emerging markets, companies with high debt loads as well. So emerging markets, early stage growth companies, because of that value ascribed way out in the future, low rates come down, you value that future growth at a higher price. Long duration bonds, right? So as opposed to having bonds that expire in 1 or 2 years, having bonds that expire in 5, 10, or 15 years gives them a higher DCF value or discounted cash flow value. And of course, large cap value. So these are the areas that we're favoring right now. So the one area, by the way, we did not talk about is crypto. We look at both Trump and his vice presidential pick, Vance, very, very pro crypto. You've started to see an unusual move where the NASDAQ moved lower, tech moved lower, but crypto, Bitcoin, has broken out to the upside. I think there's a reason why there. I think we want to pay attention to that. We have added exposure through ETFs to that space. So key takeaways here, lower inflation plus Trump may equal small cap and value outperformance. So we do think investors may continue to use large cap tech as a source of funds. We think that's a huge dynamic that we want to pay attention to. We've seen that historic rotation out of large cap tech and the small caps. This is a big deal. We think it has continuity to it. We think it has a high persistence factor. And then lastly, we think lower rates may benefit small caps, emerging markets, MSCI EAFE, which is Europe, Canada, Japan, and profitless tech over the rest of the market. So that's what we got for you this week. There was a lot there. We had big movements in the market, so I thought it was important to address all of it. We like how the portfolios are positioned. And if you have any questions, please feel free to give us a call, 888-543-3776. Reach out to your advisor. Happy to set up meetings and have an absolutely fantastic, fun, and safe week. Thank you.